How do you pick better stocks? Well, we've interviewed hundreds of investors on Stacking Benjamins, and what you're about to see might be the best. And everything we'll talk about today begins with this question. How good is your hit rate? Now, hit rate's an important term to know, and if you don't know it, that's okay. Most people don't. Your hit rate is the percentage of the time you buy an investment and it turns out that you made a phenomenal call. Now, the truth is, you probably already know that the probability of picking a great investment is bad. But exactly how bad is it? The best investors, and today we're going to call them maestros, well, they have worse than a 1 in 2 chance of making a great picking call. The majority of managers who do this professionally, their batting average, get this, is closer to 40%. And that means that for the average stacker like you and me, an amateur here, we're probably in the 1 in 3 range. So 66% of the time, you're going to make a bad call when you invest. So let's walk through the process. Where do we begin? Well, if you've ever traded an individual stock, you know the routine. You think about it. You look up some traits of the stock. You do your homework. You've thought of all the reasons this is probably the one, and then the magic moment, you allocate funds and you press the button. Now that sounds like there's all there is. But you already know that investing comes with this roller coaster ride once you're in, right? There's results and there's emotions. And there's 2 issues with this scenario. The first and the smaller one is there's a high probability that that pre-work we talked about, that's flawed. Now that's okay because most investors don't do enough or the right pre-work before buying, and we can help you work on that. But second and bigger, and this is what their guests are going to share, is that the lion's share of winning is what happens after you make the investment. We all know controlling emotions is important, but what we don't know is how systems can help you and I make better decisions that help us win more often. So that's where today's mentors come in. Freeman-Shor and Clare Levy have spent their lives looking at investor behavior. They're both former fund managers. Lee's written extensively on what makes a great investor, and Clare, well, she actually runs a company that helps improve that hit rate that we've talked about. And by the way, if you're investing in mutual funds or index funds like a lot of our stackers, this applies to you too, because as always with investing, psychology and having an exit strategy are important no matter what you invest in. And it turns out a lot of the maestros we're going to talk about are super because they've mastered that thing that Kenny Rogers said in that old song. They know when to hold them and they know when to fold them. So today, a very special conversation with Clare and Lee. But first, before that, a word from our sponsors. Just kidding. We don't have any sponsors for this video. Instead, I've got something better for you. I call it our cheat sheet. So instead of just listening where you're going to forget 85% of what we said during this discussion, or you're jotting notes that you're going to sit down and not remember later, you can keep up with the conversation and lock it in with our notes when you're done. We've already done all the note taking for you. So to get that, head to stackingbenjamins.com/cheat sheet. And of course, YouTube shows more people when you like this video, so please like it so other potential stackers can learn to invest better. I love it when we help people in this community. Subscribe to the podcast when you're out in the car, you're walking the dog, and of course, subscribe to this for more strategies you can steal like this one with Clare and Lee, because it's time right now for us to turn you into a stock market maestro. And I'm super happy we have these two, I'll call them maestros at research, here with us. Lee and Clare join us on My Dad Shortwave Radio. Thanks for coming on. I appreciate it.
Thanks for having us.
Yeah, thank you.
You know, we've had Jack Schwager on a couple times talking about stock market wizards, these people that, you know, are traders. They go, they're heavy duty. And the general thing Jack has shared with our stackers before, Clare and Lee, is that, you know, these people are remarkable. You don't want to be them. Stick with index funds. What's the difference between a wizard and a maestro, the work that you two really focus on? And I guess, Lee, I'm assuming you may have coined the term stock market maestro?
I think together we coined the term. We were trying to think of a name of what to call our experts, let's just say. But I think the difference is wizards to us are people that are more short-term orientated, more trading. The 12 stock market maestros we feature in the book, which are phenomenal investors, award-winning investors, are just that. They're investors. They tend to take a longer-term view. They're investing in public equities, names you'll have heard of, the big cap, but we got small cap guys in there. But that's the key distinction. They take a longer term view. They're investors, not traders, and they're phenomenal executors of ideas. And that's why we called them maestros. And Claire probably want to chat about, Claire, maybe what we looked at to determine how good they are at executing their ideas.
Yeah, sure. I mean, I think of both wizards and maestros are holding wands, and the wizard's going zap, zap, like point and shoot direct. The maestro has like long sweeps and is, conducting a symphony, and it's a much more fluid and less, there's something more musical about that to me. But the maestros that we've interviewed, they're all public equity long only. Well, no, some of them are hedge fund managers, but all public equity fund managers. And but in that way, they're sort of closer to us being, any old person who maybe invests in the stock market or doesn't, but invests in mutual funds or ETFs or the like. Like they're doing the long-term investment thing is what we're all supposed to be doing. So the learnings that come from them hopefully are very applicable to people who are not fund managers, but who, have yet to make decisions with their money. We all do.
And Claire, your company has a series of metrics to evaluate these people and help them to evaluate themselves, which I find fascinating, and to look at the traits that make them better investors. Is it more about process or is it more about results that makes them a maestro?
I mean, in the end, and this is how Lee and I actually met. So 10 years ago, Lee wrote a book called The Art of Execution, which was a study effectively of a bunch of different fund managers who he had allocated money to. So what he found was that in the end, the success of the manager or the investor, any one of us, it's not just about getting it right all the time. In fact, don't even get it right 50% of the time. Even the professional, very best fund managers typically do not get their ideas right at 50% of the time. It's how they behave when they are right and how they behave when they're wrong that makes all the difference. And that applies to every one of us. But it is the sort of thing you can see in data. So in Stock Market Meisters, we vetted a long list of award-winning fund managers, 70-odd award-winning fund managers, and then got their data and analyzed it and narrowed it down to these ones, because these are not all people who have a batting average over 50%. In fact, on average, they're under 50%. But what they do well is the slugging part. If people are baseball fans, in the end, it's like you can be wrong a lot as long as when you're right, you're very right. And when you're wrong, you're only a little bit wrong.
I remember Peter Lynch saying something like that a long time ago, that he lost far more often than he won. But when he won, he would be able to win big enough that it would make up for a bunch of losers. Lee, it fascinates me when Claire talks about your earlier works. You actually, in the intro to this project, you focus on the different types of investors that Claire is beginning to shine a light on for us. These different people, the rabbits, the assassins, the hunters, the raiders, the connoisseurs. This was fascinating to me, by the way. When I first read about this a few years ago, I love these terms. Can you walk through this? Because I think we all make these mistakes. We become the wrong type of investor at precisely the wrong moment, which wrecks what could have been a great position for us to hold as an investor.
Yeah. No, you're spot on. So the chance of an idea making money is 49%. And these are the best investors in the world, very successful, toss for coin as to whether an idea makes money. And yet people obsess about stock picks. And what my research showed is, no. What matters is what you do when you're losing and winning. So going back to your avatars, if you like, the tribes. So if you're losing, people will typically fall into one of three tribes. They'll become a rabbit, a hunter, or an assassin. You don't want to be a rabbit. A rabbit is a losing trait. A rabbit, someone that when they're losing, they do nothing. And what's bad about that is that invariably, if you do nothing, you could hold something that goes down a lot. And if you understand just geometry of returns. If you're down 50%, you need 100% to break even. If you're down 75%, you need 300% just to break even. You don't want to dig such a big hole. So they're rabbits. And when I found rabbits in my team of professional investors, I fired them. Okay, because they're managing between 25 and 150 million dollars for me. So you don't want to be a rabbit. You want to be an assassin or a hunter. And I'm guessing for the audience of this show, an assassin's probably the easier one to be. An assassin is someone that says, okay, I've lost somewhere between 20 to 40% in this name. I'm getting out. Like a cold-blooded killer, you just kill the position. That ensures you're not going to lose too much and you're not going to permanently impair your capital, and you can move on. I mean, you're kind of respecting the market. The market's kind of saying either your idea sucked or your timing sucked or both. And the other category, a hunter, is someone that basically, when they're down 20 odd percent or more, they kind of think, well, I still believe in the idea. Nothing's broken. It's just the market. I'm going to throw a lot more money at the name. Now that, I would argue, is a lot more difficult to do, because when you've lost money, throwing more money at an idea, it kind of plays with your mind thinking, what am I doing? You kind of doubling up might be a mistake. So, for a professional, it might be a bit easier to do that. So that's on the losing side.
When I began investing, my natural reaction was, this is a good idea. And my timing, to your point, Lee, I might have been a little early. The position is going down, so I'm going to keep dollar cost averaging into it, right? I'm gonna make my average lower, so it's easier to bring it back. But then I realized, reading people like the two of you, that this might just be my ego, my ego getting in my way, and I need to be okay with the fact that I called it badly.
Yeah, I couldn't agree with you more. I think the ego is the enemy. I mean, that's the biggest enemy of all of us. I mean, it's very hard when, you've done a lot of research on an investment, you put your money in it, and then you see it's losing, and you it's hard to walk away, especially if you still believe in the name. And sometimes you just have to acknowledge you've got it wrong. But to your point, I mean, if you've done a lot of work and you think you're right and the market's wrong, which is, can be a bit of a dangerous way to think, then pound cost averaging would make sense. Or my guys, they didn't do, I guess the difference is, for me, they didn't do pound cost averaging. The difference between a hunter and a pound cost averager is a pound cost averager would go, I'm putting, say, $100 a month into a name. And over time, that's a great strategy, by the way, if you're going into something like index funds. Yeah, I can't fault that strategy that way. But in individual names, what my guys would do is they'd go down 30% and then they'd double up. And they put a lot more money in, and that's a very different beast to pound cost averaging. And that, if you don't know what you're doing, if you're not a professional, that can be very dangerous, and you can go to the poorhouse pretty quickly. Which is why I said earlier, for an average investor, I was thinking someone like my mum and dad, it's probably better for them to adopt being as an assassin when they're losing than trying to be a hunter. Or they could do what pound cost averaging, what you suggest, isn't a bad idea if they're doing it in a traditional fashion of a little bit every month, in a name, which is a bit of a different game. I mean, Claire, would you add something?
The key thing to wrap your head around is that you have a less than a 50% chance that your idea is right. So if it starts losing, to automatically want to buy more, you're assuming that this is one of the ones that you're right about.
Right.
Okay, so that it's already you've got a less than 50% chance that this is one of them, but you're saying it is one of them. Okay. With a hunter, the hunter is saying, I've done the extra diligence. I've got really good reason to believe that this really is one of the 49% or the 40. Today, I see average hit rates closer to 40%. So you have to be able to work from the baseline of, wow, I know I'm going to be wrong more often than I'm right. So then it becomes about being aware when I am wrong sooner rather than later, and being aware when I really do have very high conviction that I'm right, and revisiting that every time to say, nope, this is one of the 49%. This is definitely one of the 40, in which case double up. But I think most people innately believe that they're right more than 50% of the time.
We're all above average, Claire. We're all above average.
Yeah. Yeah, unfortunately, that's called overconfidence, and it's very well documented behavioral bias. And it's something we all struggle with. But if we can be honest with ourselves and objective and forgiving Not saying, "Oh, I get it wrong more than 50% of the time because I'm a bad investor or I'm stupid or whatever." No, that's just you being a normal person. But knowing when you're wrong, in other parts of life, you have signals that tell you like, "Hang on a second. I have a feeling I'm barking up the wrong tree here, or this is not the right person I should be with." The red flags are there. We have to learn how to recognize them when they're there, cut our losses and move on and take it on the chin. And I think it's easier to get to that humble space when you've taken more punches, the longer your life has gone on.
I love that because, often a lot of our younger stackers, they're afraid of making the mistake when they first start. And what you're alluding to is make mistakes more often, fail forward. Lee, you were about to transition into the winners on the winning side, where we get it right and where we get it wrong.
Yeah. So when you find yourself winning, people typically fall into one of two camps. They'll either become a connoisseur or a raider. And as much as I like Raiders of the Lost Ark, you don't want to be a raider. Raiders, these are people that make 10 or 20% and they bank the profit, move on. Now, when you realize your success rate is less than tossing a coin, banking 20%, believing that you're going to rotate that profit into a better investment is a bit of a fool's errand, I'd argue. And the main finding is you want to be a connoisseur. Connoisseurs are people that you run your winners and you win big. You let your winners, compound out and win big. And I can tell you that the guys on my team that were successful, they all had one common factor amongst them on the winning side. 2 or 3 big winners accounted for the majority of their returns. So if you strip out one of those 2 or 3 big winners, their returns profile of their overall portfolio becomes very average or bad. And so you can't underestimate the importance of having 1 or 2 big winners. So if you've got a process whereby you're selling out of your winning names after making 10, 20%, and then you're holding on to your losers and ride them down 50%, you're going to go to the poorhouse pretty quick. So be a connoisseur when you're winning. That's the lesson.
The case studies on these people, on these connoisseurs, to me is so fascinating. And the things that they share, the things that you got out of them are incredible. I'd like to talk about, let's focus on one at first and then just talk about some traits that you found throughout the book, a few of them. But Claire, let's start where you start with Josh Goldberg. Who is Josh Goldberg and why did he make it into your very, very short list of maestros?
Josh is a hedge fund manager based in New York, and he actually, of all of the maestros, has one of the most traditional backgrounds in the sense that he went to Wharton and he, went to work for hedge funds and he worked with all these well-known fund managers and learned his trade. Whereas, of the other maestros, they come from all different backgrounds, all different educational training. They all ended up getting finance training eventually. But Josh is probably the most traditional in that way. But what he has developed is a strategy that is very process driven, very straightforward in that it's based on earnings surprise and it taking signals from the market. And it kind of goes back to the same point. It's like, you're going to be wrong at least 50% of the time. So you need to constantly be asking yourself, what evidence am I getting back from the market that this is one of the right ones? And for him, that's earnings announcements where, a company reports their corporate earnings and the market responds very positively. And he doesn't mean just like a little bit positively, like big gaps positively. To him, that contains information and it reinforces his conviction that he's right about that one. So it becomes, yes, I think this is one of the 49%. And then he has implemented rules around what does it take to get into the portfolio. So you're either convinced or you're not. So you're not going to have tiny little positions for any length of time. It's either going to show you it's going somewhere or it's not. But also when things start going wrong, he's got signals worked out through analysis. And he is a client of Essentia Analytics, although I should say only half of the maestros are people I ever had met before. The other half are totally random, but people who I was able to get the data for.
To stop you just for a moment, Claire, to clarify, he uses your data to get better.
Yeah, he is a continuous improver by nature. And I would say all of the maestros, that is something that they have in common. They're all humble enough to look in the data mirror, which is not, it sounds like, of course you would be, but no. Looking in the mirror can be kind of mortifying sometimes. And not everybody is feeling brave enough to do that. But these guys have all gone there, had a good look, figured out what it is that they're not perfect at, and either created rules or signals to help them manage their own emotions and, mitigate the biases, or they've used it, what they've learned, to substantiate, like, okay, here's how we hold on to our winners. So, to achieve what Lee described in the having a handful of really big winners, you have to hold on to them. And that's a brave thing to do a lot of the time. So it's like, you've ever heard the quote about you don't want to be watering the weeds and cutting the flowers.
Oh, yeah.
You know?
Yeah.
It is like a garden, if you think about it that way. When you plant all the seeds, every one of those seeds is a precious, this is going to be the best flower ever. And you put them in there and you water them, and then things start growing. Some of them work out way better than you thought they were going to be. Some of them, there's nothing there. What's going on? It's not growing, and you just have to keep on testing the soil, watering, fertilizing, doing the things and nurturing the ones that are going somewhere and clearing out the ones that are going nowhere so you can plant something else in their place. And that's what these people are doing, both with their portfolios, but also with their investment processes.
Can we talk? Let's use Josh to kind of dive into some of the tactics of getting in. He uses, as you just explained, he uses this idea of earnings surprise. Does he try to predict which company has an earnings surprise beforehand, or does he do it after they've had an initial earnings surprise, Lee?
No, he always waits until there's been an earnings surprise. So he's not trying to be a soothsayer and forecast the future. He's in that sense, a company was surprised on earnings, and then he and his team will dial up the research on the name.
It makes it easier then to filter, I would think, Lee. I mean, working from this whole wide range of companies to just a few every quarter that probably surprise.
Mm-hmm.
Yeah. Now it helps narrow down the universe, and then he'll jump on those that have surprised and decide which ones to allocate to. And I think the other key thing about Josh is, he does that, he allocates capital to them, but then it's how long do you ride it for? And this is, all the maestros have one thing in common, which is they're masters of execution, because it's how you execute the idea matters. So in his case, what does a connoisseur mean for Josh? And what you find with him, thanks to working actually with Clare, he's discovered that his sweet spot is to hold a name for about 15 months. So during that time, generally speaking, the earnings will surprise and keep surprising. But if you hold on after that, you risk kind of round tripping the name. But during all that time when the earnings are surprising, him and his team are constantly on it, looking at it, thinking whether it will go more. But he's got that flag that pops up around the 15-month mark, which is okay, usually this is where it can start fizzling out. Do we still want to be in it? And, that's some of the wisdom he's learned working with Clare over the years and, feeding back and improving his game.
This way of getting in, sounds like a machine, Clare. He starts off the machine with an earnings surprise. They go into the funnel, and then, then he works it through all of his other processes that he has. To me, this kind of speaks to the idea of an investment policy statement, right?
Mm-hmm.
How big is an investment policy statement to these maestros, not just Josh, but all the ones you looked at, versus my gut tells me that Apple's going to be big next quarter?
None of them are the gut. That just, once upon a time, that is what we thought made a good trader, that they were born that way and they had a great gut. Now, it is possible that some people are better at pattern recognition than other people, and that their gut is that. But all of these maestros have documented process that they follow, and it typically involves other people, not just themselves. They have teammates that they converse with when things hit certain levels or when certain things come up. Some of them have very formal, when this happens, we sell this percent. So James Inglis Jones and Samantha Gleave from Lion Trust, who are also maestros profiled in here, they have what some people would call that a systematic fund. The humans, in their case, are making decisions, but they have literally implemented rules that say we always do this when this happens. In Josh's case, he's not applying that rule as rigidly. He's saying, okay, I get a flag at month 15, and that I look at that and say, all right, here's 5 other reasons that it's probably time to get out of this stock. And now, and the fact that it's hit its 15-month birthday, we know statistically that in the past, that's tended to be the end of the road.
Yeah, I'm in the danger zone now.
Yeah, and it's just the odds start to move against you that this is one of the ones that's going to keep performing. So now you have to ask harder questions of yourself to justify hanging on to it. So he's sort of taken a slightly more human approach to applying these statistical rules, but in the end, they both use computers to work out where is it historically that I should have made a decision, what should that decision have been, and now I might use that to always make that as a rule in the future, which is what James and Sam did, or in Josh's case, say, okay, well, I'm going to use that as a guideline for helping me make a decision as a human.
I'm glad you focused on that because I feel like too many stackers out there, too many just individuals hear about their buddy at work did something or they're in this wonderful fund. And because of that, it's going to fit my portfolio and it could be right for you and might not be right for you. And it also might not be any good for the person who's telling you about it. Like who knows what process they use. I love that. All of these maestros also, Lee, have a process of getting out. And often, and you talked about this earlier, with Josh, there's this risk after 15 months that he might follow it up and then all the way back down, right? And you definitely don't want to do that. What are some of the keys to figuring out when I'm going to get out of a position that might not serve me anymore?
For each of the maestros, and the point of the case studies where we follow them in one of their investments or 2 other investments in terms of which worked and didn't work. So you can actually see what signals enabled them to sort of decide I'm getting out or not. If we stick with Josh, he will not lose more than 1% of the fund in any idea. So, once he's lost 100 basis points in professional terms, he's out. And some of them have those kind of hard rules, which is, once I've lost this much of my money, I'm out. I don't care if I like it. Still, it doesn't matter. I've lost enough money. Idea could still be good, but I've lost now. So some have that. Others will have different signals which trigger them as to when they should be getting out. A lot of the times, if they're wrong, obviously these are professionals, they'll be getting signals from the company itself, in terms of looking at the fundamentals and things like that. That will trigger them to actually get out.
This is like a new earnings report comes out or something, or more news comes out.
Yeah, it could be something like that. Yeah, where some news flow comes out about the company, or they read the quarterly report, or they have a meeting with the CEO management, and if something doesn't quite smell right, and they think, no, I'm getting out. So I think you'll find that quite interesting for each of the investors, that there's a myriad of soft signals, right, which could trigger you to get out in terms of, there's loads of them. So you have the soft signals from the meetings with managers, reading reports, and then you have the hard ones, which is, that's it. Some will have rules like, okay, I'm down 20%. Let's review the name. And they do, that's a trigger, so it's not a stop loss. Like I think, a wizard or a trader will have stop losses, lose 5% out. Maestros, because they play a longer term game in public markets, investing in stocks, they're more, okay, down 20%. Let me review, get the analysts together, or they start looking at the investment case again. And then they have questions they'll ask themselves, which are simple but powerful questions, such as, okay, if I didn't own this already, would I buy it today? And you've got to be honest with yourself. And that's the difficult part. Try and forget you've lost a lot of money and just say, if I was looking at this today, looking at the share price like this, everything I know, would I buy it today? And I think a lot of people, if you ask yourself that very simple question, you'll probably go, hell no. And if that's the answer, you sell. You run for the hills.
But what I would think, Lee, helps you there is if you've built a system like we talked about, you have an investment policy statement, you just apply the top of the funnel of your investment policy statement. If the answer is no, I wouldn't have bought this, it wouldn't have fit in the top of my funnel, then it makes it easier to get around your ego in that case, I would think.
Yeah, big fan of Clare as well, I think. But it's, you should, in my first book, The Art of Execution, I always talked about the importance of having a plan of action before you put capital in a name. because trying to decide what to do when something's lost money and you're in a hot emotional state, it makes it 10 times worse. If you've already got a plan of action as to if things go wrong, here's the checklist of what I'm going to look at. Things I'm going to look at. If I see this happen, I'm going to get out. If I see these, it's red flags. If I lose this much money, I'm going to get out. You should have all that set up before you even put a single penny in a name.
Then you have to follow it, right?
Then you have to follow it, yeah.
People will put a ton of work into their investment policy document, and now the document's in a file, and now we've never seen that again. And it's like, that's the human in the end, like undermining him or herself. So that's where using technology is key, because you don't want to have to dig that thing out, every time. It needs to be super handy, really easy to do. Actually, easier to do it than not do it would be even better. And that's, I think, the biggest piece of the puzzle. How do you get yourself to actually follow the process? Because you have great intentions, but if you make the process too complicated, you're not going to follow it. So it needs to be somewhere in between non-existent and like super thorough.
I think we even need to do that like in our work lives, work on the machine. Don't just go do stuff. Make a machine of doing the things you do every day. And it feels like it's the same here. Lee, you were going to say something?
I was just going to add, with all the sophistication in today's world, a couple of the maestros adopt simple tricks that even I did when I was a fund manager. One of them, Stephen Annis, he has a laminated piece of paper stuck on his desk. So he's got his key learning messages and golden rule, everything there so he can quickly flip down it and just to remind him of things that matter. And another one, John Lin, who's, arguably the greatest investor in China. So one thing we didn't discuss, we've got US investors, European investors, global investors, and we've got the best investor in Chinese equities in the book. And for him, he has, behind his desk, he's got, a corkboard, and on there he's got pinned key rules, which, every day you can look at, just glance over his computer, look at, just to remind him of the salient things in the moment that sort of like are there. So you don't have to Claire's point, dig out that policy document and remind yourself of various rules. So, simple aids like that. I mean, when I was a fund manager, I used to have Post-its around my computer, actually. So,
I still do.
I had my screensaver was some of my big important things to remember when I walk in my office in the morning. Like they were on the screensaver before I shook my mouse. There it was, right in front of me, every freaking day.
Yeah, I like that.
Yeah, same thing. I do have a couple more questions before we say goodbye. One, Lee, you mentioned international maestros. We have a few U.S. maestros. We also have international maestros. Claire, did you find anything that really changed when you're looking internationally versus just looking one country specific?
I mean, every one of these maestros has a different strategy. And, there are a few that are looking at small cap stocks and a few that are looking at large. So they might have a little bit of commonality in terms of what they're looking at, but they're all looking for different things. And I think only in the case of John Lynn, probably is there a very region-specific thing going on, and that's really to do with the characteristics of the Chinese market being so dominated by retail investors. And so the way that prices behave it's like how they behaved decades ago in Western markets. So he's able to do a strategy that you probably wouldn't be able to do elsewhere just because of the market opportunity that exists. But Lee, would you agree?
Yeah, 100%. I mean, he'll talk about, in China, people will, the taxi driver will buy something on Monday, sell it on Friday. Professional fund managers, he was even telling us, which is quite shocking, their bonus structures can be based on weekly and bi-weekly performance. So they're incentivized to basically lock in profits very short term and trade like crazy. So a lot of momentum investing approaches that work maybe, in the US, for example, would be a disaster in China. And he shares these insights with the reader of the book, and he's incredible, but he's got interesting, I think that's an interesting case. So he's the most differentiated, I'd say, of all of them, because the Chinese market's so very different.
Yeah, I just found the case study so fascinating. And to your point, I think you said it earlier, Claire, just how different their strategy is, but their adherence to it, they would come in every day and just work the system. work the system and improve the system. And man, that resonates through everything that these men and women do. One place that our stackers are doing something different than your maestros are, which is, they're trying to put together a portfolio for their retirement. So instead of focusing just on small cap or large cap or international or whatever, where a lot of these people are focused on one market, they're focused on the broader, getting some of each. But still, diversification, it seems like, Claire, matters to these people. Like having only so much money in a certain position. Is there ever a time that you see that for somebody, it makes sense to begin selling it, even though it's a winner, just because your exposure becomes too high and the risk becomes too high?
I mean, that's actually an interesting one in that we have different approaches amongst the maestros. So there's one maestro called John Barr, who he's a small cap specialist who he knows a particular part of the tech space like especially well because he used to work in that industry.
I felt like he was that kid. You made a baseball reference earlier, Claire. He was my friend growing up who knew the back of every baseball card. Like he knew which farm team kids played for, like all their middle names. He knew everything. John Barr seems like that kind of person.
He definitely is that guy. He definitely is. But what he does, and we call this the lumberjack tribe, a brand new tribe, is plant seeds and then, let them grow really, really big, like way bigger than a lot of the other maestros would. Some of them would say, I never let a position become more than 4% of the portfolio. Now, sometimes it's because the rules of the fund that they're running are such that they can't. But in John's case, he really takes running your winners to heart and lets them become very large. And that's a way of making money. And
what does he think about the danger in that? Because he clearly is a brilliant guy. He knows that his Achilles heel gets bigger as that tree gets bigger and bigger and bigger, and he doesn't chop it down. How does he handle the risk of that?
That's a good question. I think now he is not an Essentia client, so I don't actually know the detail of the way that he does it. But I think that he's watching drawdowns, and he's definitely, when he has a big winner that then comes back a good way, he's reevaluating on the basis that does this story still hold? Has it got that much more juice left in it? Because it's so easy to fall prey to the endowment effect, which is, the bias whereby we value something highly because it's ours. And you can fall in love with a stock. You can fall in love with pretty much anything, the longer you have it, it grows on you. And maybe it's made him a lot of money. It grows on you that much more. But the risk is you don't see the cracks start to form, and then suddenly it's over.
It's like Lee said earlier that you put it back at the top of the funnel. Would I buy this today? Is kind of what you're saying that he'd do. But it's funny, Claire, that you bring that up because you're really showing him as different. For most of them, then, it really does matter when something, because if you're shining a light on John where it doesn't, I think what you're also saying is for the majority, though, it does matter.
You mean how big the
how big the percentage of the fund is dominated by one or two different investments? Or are you not saying that?
It depends on what type of vehicle they're running, because different vehicles will have different rules attached to them. But for most of them, and Lee, feel free to disagree, but I think for most of them, they do have a strict rule about not getting bigger than a certain size. And that might be 5%, that might be 4%. It's somewhere in that region.
Yeah, I mean, I'll just jump in and say, so if you look at someone like, let's take James Hambry, for example, UK hedge fund manager in the UK is very famous. He's a guy that made over 100 million in 2016 from positioning his portfolio from benefiting for the UK leaving the European Union. And if you look at him, we share an example in there of something like plus 500, where he's been in it since 2013. He's made over 6,000%. And this is a name that's had, 50, 60, 70% drawdowns along the way. But the way he controls risk and is being able to win so big is he will adjust the position size. So at various points, you'll see that name being as low as 1% and then as high as 9%. But the way he tries to size it, so he plays a sizing game, is he moves incrementally. So he's aware that psychologically, emotionally, we want to do the wrong thing at the wrong times. So he'll increase and decrease his positions in 0.5% steps. So if he's 9% and he thinks, oh, yeah, maybe this has gone up a lot in the short term, and maybe I should take some chips off the table, he'll go from 9% to 8.5%. Then he'll take it to 8%, then 7.5%. So he moves like that, slowly and incrementally. If you have someone like, we talked about earlier, James English Jones and Samantha Gleave, another UK pair, but they invest in European markets, they'll have a process whereby it's more systematic. But if something's working during the year, they let it run. They're looking at the quarterlies every quarter, and as long as it's working, it's fine. And then every year they have the hard, if you like, the hard reset. Would we buy this today? And at that point, if they would still buy it today, but it's won and it's gone up to, say, it's grown they start at around 3% position. But if it's grown to about 6 or 7%, what they'll do is they'll take it back down to, say, 5%. They don't take it down to 3%, though, like a starting, which would start, because they recognize that often winners keep winning. So to hack it right back would be a mistake, and sell out would be a definitive mistake. So, that's what you'll tend to see. A lot of them don't let positions get to you. Greg Badia, who's another one, US, great investor in the US, he'll tend to invest at about 2% position, and he'll let it run up to about 6% position. If you think about it, to go from 2 to 6% of your fund, it's got to have done very well. And when it gets about then he'll start trimming it back. But all of them will trim back. And one last thing I'd say about John Barr is he's a guy that, we've got an example in there of one of his best stocks, and it just remind me of the name. It's Nova. And Nova, he's made 100x in Nova since he's been in it. 100x. But if you look at what he does, he'll invest in it at outset very small, like 10, 20 basis points, so 0.1 or 0.2%, very small. And when he invests, he calls it a hidden compounder. So he realizes in early, no one's focused on the name, and it could go wrong, right? But if it goes wrong and it's only 10 or 20 basis points, it doesn't matter. And that's why we call him a lumberjack, because if it goes down 70, 80%, he can kill the position like an assassin would, but it hasn't cost him a lot, which is different to a rabbit. It'll be 4% position and drive it down that much. But then as it works, it starts to growing. He'll let it grow to a 2 to 5% position. And at the point when it's a 2 to a 5% position, that they've become what he'll call a quality compounder. So he's, what was hidden is now there on public view. People know about it, and it's delivering. And Claire's point earlier is, as long as it keeps delivering, he'll keep riding it. But again, he's not going to let it get too much bigger than that. So they all, definitely, you won't see anyone holding more than 10% in a name.
I find that fascinating, though, because he can plant a lot of seeds when he's planting them that small.
Yeah. That's the key distinction between, earlier I said you don't want to be a rabbit, right? And that's because rabbits, in my world, when I was investing, my guys invest in just 10 ideas, very focused funds. But if one of those ideas goes wrong and it's a 10% position and you ride it down 90%, you've cost yourself 9% at a fund level. It's a huge hit. But for someone like John Barr, if he's got a 0.2% position, or I would say a 0.1% position, it goes down 90%, it's done nothing. So it doesn't matter. So hence we had to come up with a new name for him, which we called the lumberjack. And just to explain the lumberjack, his family background is from Chicago, and his family is a lumberjack family. And he ordinarily would have gone in the family business, but as he describes, he wasn't really cut out for it. He shares a story about him driving the truck with all the tree trunks on the back, and he went around a corner and all the loads spilled over the road. And, and it took him all day to get those logs back on the back of the truck. And he says, I really wasn't cut out for the family business. So Claire and I are thinking, what sort of captures that, and the fact he invests with small position sizes at outset, sort of that forestry kind of horticultural kind of background, and planting seeds seemed to be, and Claire came up with, thought, lumberjack, which I thought was great, fits in with a family name, planting seeds. It's wonderful. So, perfect.
Takes care of all the above.
Yeah.
I absolutely love case studies. I learned so much more through case studies. So I was super happy when I heard that the two of you had created this marvelous project. It's called Stock Market Maestros: The Winning Habits, Strategies, and Mindsets of the World's Best Investors. And it's available everywhere, correct?
Correct.
Yep.
Yeah.
Awesome. Claire, Lee, thank you so much for shining a light on this for our stackers that don't get to look really at what the pros do. And it's so enlightening and I think so helpful what you did today. Thank you so much.
Thank you.
Thank you for having us.
Well, big thanks to Lee and Claire for joining us today. You know, I want to walk through a few of these things because I think that these are some super important points. Number one is going in knowing that your hit rate is going to be bad, I think is really important because these maestros have the temerity and the willingness to be wrong. And they're okay with the fact that they're going to be wrong. And knowing that it's going to be just a few wins that make everything right, I think is a great part of winning. You know, all of us, we want our whole portfolio to go up all the time. But what does that mean? No portfolio goes up all the time. So when we create a portfolio where it all goes up, well, then it all goes down together and then we're in a mess. So we have to remember that this hit rate of trying to get close to 1 and 2 is great. But I also think that picking based on that investment policy statement is a super important discussion that Claire and Lee and I had, because not working off of emotion, working from a system is a much, much better way to invest. Now, people have asked me in the past, what is a good system? Like, how do we begin to create our investment policy statement? Our cheat sheet goes over that, stackingbenjamins.com/cheat sheet. But let me give you a piece of it now. You can just begin as simply as saying this: I'm going to pick 2 dates a year when I look at my portfolio, and pick them ahead of time. What's great about that is just a very simple investment policy statement is that it takes your emotions out of the market. If we have, let's say, tariff issues that come up, or we have problems in the Middle East, right? We have any of this stuff, you know it's not your day to make changes to your portfolio. We know that often your hit rate gets worse when you're emotional. So by taking the emotion out of it, and by just picking a couple arbitrary days, I'm only going to evaluate my portfolio on this day and on this day, man, that's going to make a big difference. I think that's a great place to start. And by explaining that, I hope it helps you see that having this investment policy statement isn't as complicated as you might think it is. We hear that phrase, investment policy statement. We think it's like this big deal. It can be, don't get me wrong. I'm sure that the fund managers that Lee and Claire work with, they have very extensive investment policy statements. But if you just start with that little thing, that's number one. Number two on there, of course, is how are you going to diversify your portfolio? That's going to be in relation to your goals. Now, these fund managers, these maestros, they are running money for other people, so they don't have a set time frame, but you do. You want the money for some specific purpose. So by focusing on what the time frame is, then looking at how you diversify those assets, and then only changing that diversification during those meetings or getting back to that diversification, something that we talk about when we talk about rebalancing your portfolio, that I think is worth its weight in gold in an investment policy statement. So thank you for hanging out with us. By the way, if you didn't take us up on the cheat sheet earlier on, we have that for you, stackingbenjamins.com/cheat sheet. We also have a newsletter that dives into topics like we talked about today on this video. So if you don't always have time for videos, stackingbenjamins.com/201 gets you there. We also have local groups, which we call Benjamins After Dark groups. We'd love to see you at a Benjamins After Dark meeting. Come join us. We currently have 6 of them. We're launching them all over the United States as we speak, so you can be around like-minded people. Of course, subscribe to the podcast for when you're in the car or out walking the dog, and subscribe to this channel for more strategies you can steal, like this one with Claire and Lee. I love talking to them. I would love to continue this in the comments. Talk about what your investment policy statement looks like. What are the things that maybe you struggle with? What are things that you're really great at when it comes to your investment strategy? I'd love to have this discussion continue. I'm Joe Saul-Sehy on behalf of the entire team here at Stacking Benjamins. Keep on stacking. We'll see you next time with another strategy you can steal.